Hey everybody, Randall Cornet here. Hope you guys are having a great day. The main purpose of this video is going to be, the main reason why you guys are probably all excited is the 005 that was reintroduced to DTCC's website today. So that is going to be the main purpose of the video. We are going to go over some dark pool data at the end of the video because I know that you guys do enjoy that as well. So if you enjoy the content, do me a huge favor, like and subscribe. It does me a huge favor in going a long way when it comes to connecting with you guys and obviously getting more exposure and the word on AMC out. Just looking at this 1 minute chart today, you can see we opened up and we absolutely ripped. We had a really strong today, finding some resistance around the $64 mark. And then we kind of, in my opinion, this wasn't a sell-off. This isn't retail selling or panicking. This is pure manipulation. And I thought that we bounced back pretty nicely. You can see here. And then for the rest of the day, it looks like there's this, consolidation and then a nice little gap up towards the end of, or the beginning of the post market. The levels I'm expecting to test tomorrow is $60. And then the next resistance that I see after 60 would be this $62 range. So if we can get over this $60 hump, I would expect us to test this resistance at 62. That being said, we can move past the charts now. So the 005, yes, it was released today, and it's a 115-page document. It's a lot of stuff. I'm going to try and just give you guys the juice of it, and then obviously the interesting perspective that I did find on Reddit that I thought is I'm gearing towards believing more than my own interpretation. So that being said, the 005, what it is, it's the DTCC basically saying there's going to be a record created for any lent securities that's going to show the status as lent, so it cannot be used again in another transaction. So if a short is going to borrow a stock and put collateral up, that stock is going to basically be marked in their system as lent, and nobody else is going to be able to come in and do what they want with that stock until the person that originally had borrowed it and issued collateral to borrow it returns that share. And the way that I see this, it's basically preventing lenders from lending out already lent shares and allow for better reporting and transparency in the markets. The idea is that they want to make sure there's always a record of lent securities out. And the only way that the record can be cleared is if the security is returned from the original borrower or owner. So if that person takes that share and sends it down the line or whatever, they're not going to be able to come back with some other fake bullshit and be able to clear up that position, right? And the most simple way I can put this, you can't borrow the same banana once, and you can't use collateral to do other bets, also known as rehypothecation. So what happens is a lot of times with this, this is what gets into the other outlook of this kind of somebody that has a little bit of a not counter, but has a different interpretation of this document. And what they're saying is that when you're borrowing or shorting these stocks, like, yes, they're tracking that the stock is being lent out and they're tracking the collateral, right? But the idea is that it's never changed. Like on an operational level, yes, it's changing hands, but you're like, the person is never giving out their collateral. It's more something that just wrote in the books, right? And so what happens is these guys will use their collateral that they use on, party X and Y, so that collateral in theory should be gone, but they'll go and use it on party Z also. And what this is going to hopefully do, or what this rule prevents, is from then being able to do that. So, you're only allowed to borrow one share, and nobody else can borrow it, only one borrow. And that stock is going to be basically shown that it's lent out on the DTC system, but also that collateral that you're issued, you're not going to go and make other bets with that same collateral. So that's an overall breakdown from my understanding of the 005. But what's interesting, what I'm going to pull up here is somebody that had a very smart theory on the DTCC is actually already doing this currently, and that our interpretations are actually incorrect at the moment. Like it's basically the 005 is just some basically verbiage changes. So we're just going to go into this. Forgive me for reading, but I'm just going to, because this guy did such a well job, he was eloquent in explaining it in a way that I can understand. I'm just going to go ahead and break it down for you guys. And I got to give credit to C Diggs. I did reach out to him, by the way, C Diggs, if you read this, and I would love to have you come on, and I'd like to talk to you a little bit more about your findings and thoughts on this. So that being said, we will jump right into it. So yes, he believes that the 005 is being misread entirely. And he's talking about another thread where people are talking about this, and it's just kind of people echoing off each other with incorrect information. The amendments and strikeouts are because of a minor technical change to reflect how the DTC already works today. So what he's saying is that a lot of the stuff that they're seeing in this document that were striked out, amended, were basically is how the DTC is already functioning proper, like currently. So basically what the DTC is saying, that they're an underlining mechanism right now doesn't actually move the security. So this is what I was saying earlier. So when somebody's putting up collateral or lending, that it's just going on the books. It's actually not happening, right? So in just reading this from page 22 of the actual document. However, as more fully discussed below, while the settlement guide and the pledgee's agreement make reference to the movement of securities to a pledgee's account, from an operational standpoint, DTC does not, in fact, credit a security to an account of a pledgee. What the pledgee receives is not a security entitlement. The securities remain credited to the pledger's account until the pledgee releases the pledgee security or makes demand for the pledgee security as discussed below. So what they're saying is to say on our books we have it, and we're marking it that it's lent out, that your collateral, or that we've lent this out, but we're not going to demand for your collateral, or we're not going to demand for that security back until we deem that it's necessary. But our books are showing that it's lent out and nobody else is going to be able to borrow that share, right? I hope that makes sense to you guys. That's the way that I took this. If somebody has a different understanding of that, please drop a comment and let me know. So rather, a notation is placed on the account of the pledger. The securities are pledged to the pledgee, and the securities remain in the pledge status until the pledgee instructs otherwise. So he's saying basically what happens today is when you purchase a security, it may not actually get transferred except on the books. The actual transfer of the security requires an entitlement order. And then he goes on to say in page 28, a pledgee has control under Articles 8 and 9 of the NYUCC and under the DTC rules of any security entitlements pledged to it through the facilities of DTC, and the pledgee is empowered to issue entitlement orders to the DTC to direct the release, delivery, or withdrawal of any such pledged security entitlements. So what they say that they can have through an entitlement, they can demand these securities, but until that happens, it's just basically done on an operational level, like in a ledger, for lack of a better word. So DTC says that the entitlement orders allow the buyer of a security to demand the delivery of the security because the purchase of a security does not actually require it to be transferred, only that the control and benefits of holding security be transferred to the pledgee. What DTC says is actually better explained on page 29. And it says, pursuant to the proposed rule change, DTC would revise the text of the settlement guide to reflect the pledged securities do not move to an account of the pledgee. As discussed above, the movement of the security is not required to affect a pledge and does not impact the rights of pledgor or pledgee under the rules of the NYUCC. Rather, a pledged securities continues credited to the pledger's account, however, with a system notation showing the status of the position as pledged by the pledger to the pledgee. Again, going back to this thing, so they're not actually giving any of this out. They're just writing it on the books. They're just putting it in a ledger, which is good for tracking purposes. It is good, and it's good that shares can't be reborrowed or reapothecated. But what my understanding is, this is already happening. Okay. So this is purely a technical change, in my opinion, as it relates to how the system is tracking transactions and better reflects how the transaction is handled in real life. This text, the status systematically prevents the pledge the system. Let me just go back before I get tangle my words all up. This status systematically prevents the pledge position from being used to complete other transactions, which is consistent with the pledgee's control over the pledged security as discussed above. So even though they have the securities and they still have their collateral, they got the shares that they borrowed, they didn't give their collateral up, they still have it, they're still saying, because we have this all in our books, we'll be able to watch. You're technically not allowed to go and do any other bets with this type of collateral. He's basically saying, though, this is not a change. The change is how they are tracking this in the system. But because they are realigning the agreement with how they are actually doing the change, they need to modify the text of the other parts of the document to reflect this change. What you are picking up and what other thread picked up is the change in the text without understanding why they are making the change. They made those changes because they are clarifying they do not actually transfer the securities. They only mark the securities with a notation. All aspects of control of those shares remain the same. On page 4, they write, as discussed below, the proposed rule change relates to the technical aspect of the operational processing of pledge transactions and would not impact their rights or obligations of a participant or pledgee. And then again on page 11, the changes to the settlement guide text are technical in nature. Again, the changes to the settlement guide text are technical in nature, and while enhancing clarity with respect to the book entries performed by the DTC as they relate to the pledge activity, the change would not impact the rights or obligations of participants and pledgees. And what they're basically saying is, hey, this is actually how we're already doing it, so we're just amending our agreements to reflect that. This is probably also why this change has no comment period and no SEC approval is needed. So the 005 is basically what he goes to say is has nothing to do too much with rehypothecation, failure to delivers, and deepen the money calls. Sure as the sun rises, we are going to see all three again next week. So I'm just saying this. I think it's good. I just think it's important to realize that this is something they might already be doing. And this is and they just might be making some verbiage changes to their agreements to reflect it a little bit more accurately on how they are currently handling this. There are some bigger rulings that I'm much more excited about, especially after learning more about this. At the end of the day, guys, we know where we're going. We know what direction we're headed. So I wouldn't worry too much about these rulings, because at the end of the day, they're like a chain linked fence. They all have to be tied together to work anyway. So I think it's going to be a combination of all of these rulings. That being said, it is good that they are basically going to be tracking these lent out securities, and there's going to be a ledger for this, and you're not going to be able to go around and use the same collateral across a bunch of different places. So that being said, I hope that you enjoyed that. What I do have up here is moving on to the dark pool data now. We're looking at AMC, and this is a chart dated all the way back to January. And this is our first initial run up in January. And why I have this historical chart pulled up is because I want you to look at this, basically the dark pool data, which is this dark pool, the light and dark pool, or dark blue bars. Okay, so the green is the actual volume, the dark blue and the blue are actual the actual volume, the buying and selling. Dark blue indicates basically buying, and the light blue represents selling, shorts. So if we come over here, this is where we're currently at now. This is our June date over here to the right of the screen. What I do want to show you is we're kind of mimicking this pattern again. You can see it was really, really, really dull in March and April, and start around May again, and we started ramping right back up. So there's a lot of selling pressure too in the dark pool. So a lot of this chart is showing there is a lot of selling that's going on in the dark pool. Interesting to see. I do want to show you guys also market. Let's go to Market Chameleon and let's go check out. This is basically, you guys, I actually think that you can view the VWAP and the dark pool stuff for free here. I do have a paid account, but what this tool is called is Market Chameleon. And if you go over here to the left under stock info, you can check out VWAP. And if you go to trading hours, this tab, trading hours, you can see the dark pool volume, which was insane today, 153 million, 62.7% of the volume. So if we go back to our other chart here, which I had, let me go back here. Let me refresh this chart. Oh, crapola. Okay, so if I want to go to, let me pull up this AMC chart again here. Sorry, it's taking so long. Okay. Now we're looking at AMC. Sorry for that little lull period. It was being really slow. So in reference to volume, so this is the volume candle. The green is a volume candle for today. This is the dark pool volume. And more than half of it was selling pressure that was going on in the dark pool. So pretty interesting stuff. I do have another video about that. I'm going to dive some really deep into this, like the dark pool stuff and what I think it means and how you can kind of use it to track what some of this, like this money flow is doing. But there's so much to cover in that video. I think it's going to have to be its own one. So at the end of the day, I think that's pretty much it. I do have a little bit more for you guys. I wanted to show you the calls that were purchased for over 500,000 for today. There's a big one, this big one right here. So it's a little bit far out. The expiration is January 21st, 2022. The strike price is $95, but this person made a $2.46 million bet on this call. That's a pretty insane number. And then we did have some big block institutional buys today here through like VWAP transactions, 12 million, 10 million, 9.3 million. That's some nice buying as well. And AMC was the most active call for today also, which is good to see. We usually don't beat Tesla that often, except when we have really good days. So all good stuff. I hope you guys enjoyed the video. If you did, please drop me a like, subscribe, all that good stuff. Let me know what your thoughts are on the 005 ruling below, and I'll catch you guys in the next one. Love you long time. Peace.